You for joining Skai's Digital Marketing Quarterly Trends Report. Looking at Q1 2025. Today is April the 24th. We are excited to get started. Before we do so, let's look at a little bit of our housekeeping information here. You are on mute, sorry, so no Zoom karaoke today. If you have any questions, please click the Q&A button in your control panel and type away. We'll follow up after the webinar if we're not able to see it or get to it during the conversation. If you're having any issues with audio, right, you can always try to dial in with your phone or certainly use mic and speakers, whatever works. And if you are looking for the slides right now, hit the toolbar's download button. If you would rather wait, they will land in your inbox, as well as a recording of the webinar about 24 hours after we wrap. So thank you for joining. Diving right in, my name is Nich Weinheimer. I lead strategy at Skai, and I'm joined by Josh Dreller, who is now coming on to the video, our Senior Director of Content Marketing.
I like to make an entrance, Nick. You know that. Thanks for having me, and we got some really great data to share with you all this today.
Amazing. So who is Skai? If this is your first time joining us, we're the only omni-channel platform built specifically for performance advertising, unifying walled garden media and complex data sets into one seamless solution. We unlock insights, we bring together first and third-party data with Amazon, Google, Meta, TikTok, Walmart, and more, so you can see exactly what's driving revenue. We streamline the execution through a single interface for campaign setup, budget shifts, real-time optimization across all of those channels. And we help measure the impact end-to-end, ROAS, incrementality, lifetime value, so you can really know precisely where and how to spend your ad dollars, and how to get them working the hardest. And all on the highest engagement, highest return touch points where, ready to buy consumers live, shop, click every day. And all that underpins the index that we sit on today, which JD will tell us a little about in a second.
Yeah, super proud of the content we put out here. Pretty valuable. We're constantly checking in with the market, checking in with our clients, and you can see a lot of this great stuff on our blog as well as across our research center. If you like today's quarterly trends webinar, well, we do it every quarter. It's in the name. You can get the report on our research hub next week, although you probably, if you're on this webinar, you probably receive an email. That report will have deeper analysis, more insights, something you can share around. But we also have consumer surveys, other marketer insights, and we do custom research. Just wanted to highlight our State of Retail Media report that we put out the last 4 years. It's the longest standing marketer survey about retail media, this exciting channel. So check that out if you haven't yet. So when we talk about what we have here in our quarterly trends analysis, the thing to remember is that it's a rolling 15-month window of analysis. So every quarter we wipe the slate clean. We ensure that there's a same store analysis, meaning that we have the client data we're looking at are for clients that have been on us for the entire 15 months. And it's a pretty huge data set. I mean, we have over 8.6 billion in spending here, over 1.4 trillion impressions and 12.6 billion clicks. We have a pretty good understanding of what's going on in the market, and we'll share that with you today.
Amazing. And just to give you a little idea of the roadmap of the conversation, we'll go through kind of key findings across the board. We'll dive into each channel specifically and analyze some of the KPIs and general trends, and then wrap, pull it all together with some nod to some additional resources you can look at. So diving into some of the key findings, we look at kind of the exec summary overview of Q1. Really it was volume, so click volume and so forth, not prices that drove performance and drove growth. We saw retail media clicks up 20% year on year, paid search clicks up 9% year on year. But the CPCs themselves were only up 1 or 2 points. So the acquisition costs were remaining pretty much in check. Social, some different dynamics, right? We saw CPMs come up about 5%, but across the board, spend came down about 3% as brands kind of cut into the low yield impressions. A broader storyline there, and certainly, some interesting dynamics given our platform and our approach to social and some of the advertiser types there, and we'll try to address some of the color. But also commerce first formats really continue to scale for us. Double-digit growth across Amazon's DSP, Walmart sponsored brands, PMax campaigns within Google, Meta's Advantage Plus, et cetera. So really the automated kind of full funnel inventory, within commerce first formats is capturing the incremental budgets. Um, really the takeaways here, right, is we saw healthy demand, some fluid budgets, really a renewed focus on efficiency, and seeing marketers chasing inexpensive volume, trying to trust their automation, maximize really the value of every impression. And we've had fielded a lot of questions and a lot of focus, obviously, on the impact of announcements around tariffs and kind of prolonged potential trade war, as you can imagine. Really, over the years, we've seen performance media tend to offer a safe haven, really, for brands' budgets, kind of in trying economic times. But with news like tariffs and things like that, so product-specific margin tends to become much more important. And should a prolonged trade war and associated tariffs persist, it could be even more imperative that brands are really focused on their tools for automation. They're pulling the right P&L data into the SKU level activation of their ads to ensure they're really pushing the highest margin advertisements with the greatest value channels. So likely we're going to have more to share as we see things unfold in our Q2 report, but just wanted to call that out. I probably won't be touching much on that, so should questions come up, just wanted to call that out up front. But go ahead, maybe JD, you can launch us into this here.
Yeah, just one quick note about tariffs. Well, we got a really great blog post that we published this week from the CMO of the Bluebird Group, Jacobs Nelson, when he talks about what marketers should potentially do in these uncertain times. I mean, some say you should spend now before the tariffs kind of raise prices, but as Nick said, we'll see all that in the Q2 analysis. When we break down the aggregate numbers, or the overview, I should say, you can see once again retail media up double digits again, continuing its momentum. Search was a big story, up 11% year over year. That's the biggest rise we've seen in over 4 quarters. And as Nick mentioned, social was a little flat. We'll get into the numbers in that section. With regards to volume, so for retail media and paid search, that would be clicks. For paid social, that would be impressions. Retail media, paid search, spend correlated to clicks. As Nick mentioned, that's where the spend was driven. It wasn't because click costs were higher. We'll see that on the next slide. But when you see this, this is a good sign. When marketers are scaling their programs, as everyone knows, one of the hardest things to do when you scale up programs is to maintain that efficiency. People think, oh, well, I'm getting such a great return. If I double spend, I'll get double return. Well, we know it doesn't really work like that. But in these channels, there's still some value here. Paid social impressions down slightly. Of course, spend was down and CPMs were just a little higher, and that's what pushed that impression number down. And then, as we mentioned, CPCs were kind of flat. Look at that, retail media 1%. So it's growing double digits year over year, yet CPCs are staying flat. That tells me you marketers are doing a great job out there, maintaining costs, probably shaving down your bids every day, making sure that you can get that scale. Paid search too, up the biggest it's been in 4 quarters, yet only 2% higher on CPCs. And then as we showed, paid social CPMs up a little, 5%. And when you mention that with the spend and the click-through rates, that's where we got the impressions down somewhat slight.
Yeah, and as we look at kind of our analysis, right, in the sort of total average on year for these channels, kind of versus the median, really the storyline here, when you see year over year average at 21%, but the median is at 6 for retail media, or 11 for search, and 2, right, for the median, really means that larger accounts are driving retail media and search totals higher and social totals lower. So median can be a nice way to temper some of the view of this analysis for kind of call it the average account versus some of the largest advertisers out there. So we sometimes just like to call that out and point out the effect that some of the big players can have in throwing their elbows out in the market. When we look at pricing versus volume, right, was it really click inflation, or was it simply more clicks, right? And so with retail media, we saw spend come up 21%, so driven by higher click volume and flat CPCs, as JD was talking about, with search coming up 11% on a 9% lift in clicks, so minimal CPC change. Social obviously coming down a few points, with impressions dropping 8%, while CPMs were climbing. when we look at kind of the commerce formats and features driving, growth in the space, where's the outsized effect? We saw Amazon DSP really surge year over year, outpacing the 20%-ish growth of the channel, which really underscores strong demand for the programmatic kind of commerce-focused display inventory that can be bought against Amazon's really rich first-party audiences and powerful measurement stack in the Amazon Marketing Cloud. PMax more than doubled spend, against an 11% general growth of the channel, really reflecting our advertiser base shift toward that automated full funnel search and shopping campaigns. Same with advantage shopping campaigns plus, 82% growth compared to the broad slowdown within broader socials, and kind of further validating the appeal of efficient AI-driven product ads on Meta. Really, takeaway here is these newer commerce-first ad formats are capturing incremental dollars across channels, driving consistent double-digit growth in spending. So let's dive more specifically into retail media. I mean, just across the board, saw really robust spend growth, budgets jumping 21% year on year, outpacing really many of the other digital channels. Really strong engagement lift, right? Seeing that click volume rise, confirming that really these expanded budgets are translating into real consumer action transactions. So we're seeing the efficiency gains here, right? With click-through rates improving by 5%, really underscores smarter targeting, more relevant ads in front of the consumer. And certainly a huge focus on the high intent consumer here, right? These commerce first formats, the sponsored product ads, automated full funnel campaigns are really driving growth and efficiency, within retail media. And we're seeing kind of the potential reallocation of budgets here, given economic headwinds. We see this across, and as I mentioned at the top of the call, like, marketers might be trimming some of the low yield impressions elsewhere and thinking about retailer networks and search channels where the ROI is clearer, more deterministic measurement. So I think as we look ahead with the scale and efficiency on the rise, retail media is definitely that nice safe haven, kind of a prime channel to capture the ready to buy shoppers with deterministic measurement. And again, reiterating the spending growth, just like last quarter, the growth was really driven predominantly by increased clicks, and keeping quite efficient flat growth to the CPCs over time.
Yeah, and as Nick, as you're talking, I just think when I look at these numbers, and we were talking about these numbers this week, just shows me retail media marketers are smart. I mean, they know what they're doing. They're moving money to where it goes. You'll see some of that in the next few charts. Breaking apart that quarter number, we can see that the months, coming off of Q4, anecdotally, I think the holiday season is just extending past December now, where people are returning things and replacing things, sizes, getting the right size, especially after the holiday meals, but also getting accessories for their products their gifts they got, like getting new video games for the consoles they may have received. And then we're seeing, February, March, but overall, once again, quarter high, 20+% growth. And we can break apart the numbers here at the quarter level and the year over year level. You can see the blue bars to the left. That's always going to happen on Q1. Q4 is the biggest year, especially for performance marketers, where we skew heavily in. And so, yeah, spend's going to drop quarter over quarter. That's nothing to really notice. I would look at the things to really look at are impressions, click, spend, very correlative. And that's because CPCs, like we said, flat, they're actually down. Look at, as the ramp up to Q4 and Q3, as well as, as we're in Q4, there's more competition. So CPCs are going to spike a little bit. They didn't really spike that much. And then they came back down in Q1 when the competition was lower. And then click-through rate, look, highest it's been in a year plus of the analysis. Really cool stuff there.
Yeah, and looking kind of cross retailer here, Amazon really still continues to remain dominant, certainly by volume, but kind of slightly mixed dynamics. CPCs were up a little over 5% year over year, and it was spend up 15%. Click growth was modest, so just certainly indicates a little bit of tightening competition potentially within the platform. Walmart's retail media network is really just booming. We've seen spend surge nearly 40% year on year, clicks up about 35%, a little over actually, all while keeping CPCs nearly flat. So proof of real strong volume growth at steady prices within Walmart's ecosystem. Tons of opportunity in their customer file and in the scale that they're delivering with the new ad types and so forth. And expanded access for API partners like us. So interesting story there. Other retailer networks, though, also are delivering lots of value. Other RMNs saw spend gains of nearly 30% and click increases of over 40%, coupled with a more than 10% drop in CPCs. So we're seeing the marketers find a more cost-efficient scale within the other RMNs outside the big two. So overall, I mean, Amazon still is commanding the lion's share of budgets, as is expected based on their pure play e-com position in the market and their pole position leading out the charge for retail media. But the outsized lifts that we're seeing within Walmart and the other retail media networks definitely signal that advertisers are diversifying and looking to capture that lower cost incremental volume beyond what's available within Amazon. And as we look at those trends kind of broken down, really the offsite display and DSPs, obviously, as we saw in a previous slide, the fastest growing segment of retail media. I mean, still the bulk of the volume is bought, via the sponsored products and the onsite, but the gold that is Amazon's first party data and the rapid growth and scale that their DSP offers and the million cuts of their audiences really just is an area of enormous continued pressure especially for enterprise brands looking to take scale and be able to measure that down to kind of long-term value within Amazon's marketing cloud. So stands to reason. And as we look at some of the trends and costs, right, CPCs after peaking in Q4, CPCs fell across all retail media tactics in the first quarter. Sponsored products saw some relief with the largest drop, kind of making it even more efficient entry point for performance marketers. But the DSP and some of the other formats still are relatively expensive, but it stands to reason with some of the inventory that's available via the DSP is going to be that double-digit CPM oriented CTV and display and video. So the overall cool down opens up some budgetary room. Really the opportunity for the marketer, right? Lower CPCs in Q1 are creating a window to scale campaigns before and if cost rebound. As we look at some of the key metrics across Amazon, right? Spend up, as we mentioned, 15%. Conversions, though, up 13% year on year. So solid top and bottom line growth for Amazon. Efficiency is improving as well, with conversion rate gains kind of indicating more qualified traffic, despite the click to spend ratio there. And that dynamic between clicks and spend, right? Click growth lagging spend, right? It reflects a shift toward a little bit higher quality, maybe premium placements, focus on that performance there. And, so takeaway, right? Investing in that kind of slightly pricier, better perverting clicks really paid dividends for our advertisers, kind of underscores the value of optimizing over just pure volume.
And this kind of is the money shot in terms of some of the things we're talking about before, being able to scale up while maintaining good return. Look at that flat line on the right-hand side. That just shows you quarter over quarter, year over year, across the 15 months of this rolling window analysis of our quarterly trends report. The fact that ROAS stays kind of where it's at as spend just increases. I mean, that's just also a sign of a growing channel. At some point, I'm sure we'll see some of that saturation and flatten out a bit, but this tells me that there's still so much value in retail media. I also want to go back just a moment. If you look at the chart on the left, we have a bunch of index charts in this presentation. I just want to explain maybe how to look at those. We indexed the first quarter of the analysis, so a year ago, as the index at 1. So we set that at 1, and then everything else is based on versus the Q1 or the 15-month of the first quarter of the analysis. So as you look across this, that's why you'll see on these index charts, the furthest bar on the left-hand side is always at 1, and then you can see easily how it goes up over time. All right, let's go to Walmart. Walmart we saw is growing pretty heavily, and where's that growing? And as we can see, sponsored brands are growing faster than sponsored products. And we know as you spend more in retail media, the search triggered ads, that volume kind of stays about where it is. It grows with user searches, with consumer and shopper searches, whereas sponsored brands are ways to get people to do more of those sponsored product searches. So We know that there's been a multi-year trend of being more full funnel in this channel. Early on in retail media was really a lot of the quote unquote bottom funnel, the really valuable stuff. But as the channel grows and more spend comes in, marketers are finding ways to bring that across. And then that plays well in the adoption story too. We can see that 70%, the vast majority of clients on our platform are using sponsored brands, but there's still plenty of value, as you can see in the spend, as the spend grows, for you to get in there. There's still efficient CPCs, et cetera. So really good opportunities on Walmart. And here are the CPCs. As you can see, sponsored brands actually came down year over year, and products stayed steady. So really good stories here for retail media marketers. Maybe you can go out and try some things that you hadn't tried now that CPCs have stabilized. Might give you some opportunity to invest more in Walmart.
Yeah, and as we mentioned, Amazon spending by format, right? The DSP, as we saw in a few different points here, continues to grow faster than other ad formats. Probably a sign that more sellers and vendors might be becoming familiar with the CPM-based buying model when compared to sponsored display, which was largely seen as a gateway to, getting the broad advertiser base that Amazon has to think about adopting, kind of more complex buying solutions like the DSP. And as we look at the adoption rates, right, the penetration for DSP was at 43%. So fairly consistent as we look kind of across the board. We saw some spend acceleration though in the DSP as budgets rose to a little over 20% of total Amazon ad spend, which is a new record. So, but it kind of signals a strategic shift. The stability and adoption plus seeing rising spend share shows DSP is kind of moving from experimental to more of a core part of the advertiser strategy. And the insight here is right is advertisers aren't really just testing the DSP anymore. They're elevating it as a priority channel for programmatic reach and targeting and realizing the gold that is Amazon's first party data. And as we look at the CPCs across the different tactics, right, in sponsored products, it's remarkably steady year on year, hovering at around $1.06, $1.08 from Q1 last year to this year. It signals continued efficiency in Amazon's core performance format. Their offsite display CPC saw a modest uptick from $1.72 to $1.83, reflecting kind of a sustained demand for the programmatic reach at a manageable price point. With sponsored brand CPCs climbing to $1.35 from $1.18, which really saw those peak in kind of Q3 last year. So it kind of shows some growing competition for the premium brand-centric placements there. And sponsored display came up, from to 94 cents from 83 cents, with a similar kind of Q3 peak and Q4 pullback. So it's clear that advertisers are increasingly paying for the remarketing and off Amazon inventory as well.
And usually sometimes when we look at the aggregate numbers across our big spend here for this analysis, when we break it down and slice and dice it, it looks kind of gives us a better understanding of where that came from. But when it comes to CPCs, as you can see, this cluster down the middle, CPCs really kind of were a little down in some industries, up a little in other sectors. As you can see, beauty and personal care right on the line. So yeah, across the board, we can say CPC is pretty stable in this industry. And here are the actual dollar amounts if you want to see. Health still leads. It's a pretty expensive category. I heard anecdotally that Meta kind of put some editorial restrictions on healthcare marketing in Q1. I wonder if that moved some spend over to search and might have pushed up the CPCs. I'll do some more research on that and have some analysis for you in our next QTR.
And when we look at the long-term year-on-year trends, right, we can kind of look at the contributing factors to the growth rate, which is marked in red. We saw kind of a four-quarter year-long run where CPC inflation was really driving a lot of the growth versus click volume. Really, in the last 3 quarters, we've seen this return to click volume driving the growth in spend that we're seeing, with costs remaining, as we saw before, fairly flat. So kind of that pivot away from cost inflation to value efficiency and conversion. And you look at the long-term year-on-year trends for spend and clicks, the growth trajectory here, right? Retail media spend and click volume has been consistent really over the last 6 years. We've seen sustained momentum. Recent quarters kind of point to this upward trend, really, despite some of the broader market shifts we might be seeing. And it's starting to become more of a mature channel with kind of steady scaling signals, deeper investment, increased sophistication among the advertisers, leveraging marketing clouds and so forth within Amazon. So definitely becoming a core part of digital marketing. Looking at long-term trends for CPC, retail media CPCs have generally trended upward over the years. Kind of increased competition that we see within the channel, really peaking in the end of 2024 as pricing hit its high point on the heels of some run of inflation, as we saw. Seeing a pullback in the beginning of this quarter, first quarter here, kind of indicates maybe moderation in some of the cost pressures within the channel. Obviously, a lot of good value in the volume that's being driven. So seeing some stabilization in general.
So for those of you who know and love me, I am a big fan of paid search. It was my first channel, my first love when it comes to digital advertising. So when I look at these numbers, these top line numbers, this is green lights across the board for me if I'm a marketer. Spend up, CPC's flat, CTR up 10% across the that's a huge number for us because for search marketers, we're trying to get as many clicks from our top keywords as possible. I mean, that's a no-brainer there. And the only way we can do that is to increase our click-through rate. So, using those AI formats, using tools like Skai, doing smarter things with your ad copy, getting smarter about consumer behavior. That's all the things, the little marginal gains, 1% here and there that lead to that 10% higher click-through rate. So good job for everyone out there. And when we look at the numbers, here they are again. Impressions down once again. I mean, can't even say it's a big deal for marketers. We don't care about impressions, we care about clicks. So in a cost per click channel like search, it's okay. For an impression-based channel, that might be a big deal, but for us, all looks great. And as we break apart the aggregate number, of course, the real picture kind of comes into place. We saw, about half accounts increased spend year over year by more than 5%, while some pulled back, probably due to seasonality more than anything. Certain sectors are going to be, bigger or smaller as the tides flow with the market.
As we look at the trends by month, 14% up in January year on year, really pointing to that halo effect coming out of the holiday that JD was talking about. Certainly a lot of optimism we felt from advertisers in January. Some of that got shaken in February and March with the new administration potentially creating some waves in global policy, trade policy, and so forth. So seeing some of that growth steadily slow down through the latter half of the quarter, but generally a steady Q1. Performance held firm, kind of outside typical peak months of Q4. So really the takeaway is, we saw maintained kind of healthy spend levels through 1Q rather than kind of concentrating solely on the calendar events of Q4. And as we look at the core trends across the different KPIs, right, we saw kind of seasonal normalization in the kind of the quarter over quarter analysis as would be expected after the competitive 4Q that we tend to see, right? And spend eases, budgets reset. So, but strong year over year momentum despite the quarter over quarter dip. Again, with impressions only down a couple points versus last quarter. Having clicks push up 9% and spend rise 11% year over year. That's a 1-2 punch. That JD definitely called out there. And again, with CPCs flat, kind of reflects renewed competition really post-holiday. So really strong efficiency gains, click-through rates jumping 10% year on year and 4% quarter over quarter. So just definitely seeing more relevant ads and higher quality traffic coming through here, right? So, I mean, while we saw the expected seasonal cool down in Q1, the year over year lift in clicks and spend, kind of definitely shows a sustained health for paid search across the board.
As Nick talked about early on in the presentation, formats like Performance Max are seeing growth that outpaces the channel itself. When it comes to AI, and look, we're in an AI world now, and Performance Max is tip of the spear when it comes to publisher-led AI tools. We're seeing critical mass, so spend is up, and look at adoption across our clients. I mean, just from over a year, You can see from Q1 2024. I mean, it's just up, and it's something interesting happened around Q3, Q4. We've seen this kind of level out. I wonder if we've hit critical mass, but folks, still plenty of time and plenty of room to get involved. Love to see that number come up here in the next quarter. And truly still value. I mean, even though spend is dramatically up year over year, look at CPCs. They're still, I mean, it just shows you that people are not just using these formats, but getting great at it. So if you're in the lead here and you're the sophisticated search advertiser using Performance Max to its best, you're probably finding ways to make it work for you even better. And you can see it there in the CPC. So I would say, once again, get involved. CPC is a little slightly over, depending on the sector. We can see once again health up year over year. As we mentioned, it might be something about Meta with some editorial guidelines in health. I'm going to do some research on that, maybe put out a blog post, see if I can hunt that down. And then here are the actuals. So if you want to know what the actual CPC is, you can see there. So some really good value there in consumer goods and retail. Low CPC, probably driven by Performance Max and other, great search shopping formats.
And as we again look at the long-term trends, right, definitely looking at CPCs driving a lot of the growth over a number of quarters preceding Q1, but major return to the click volume driving growth. So seeing a lot of efficient value and strong volume driving the numbers that we saw in the last quarter. And as we look at those long-term trends, really since Q1 of 2019, as we start this view from an index perspective, both spend and clicks have trended steadily higher, so roughly doubling and to tripling almost over 6 years. And so it's pretty strong resilience through some significant volatility during that time. Occasional dips, right? Early 2020, late 22, right? Reflect kind of the macro and seasonal shifts you might expect, but each pullback was quickly followed by renewed growth. And seeing 2025 rebound, both metrics resuming their climb, clicks and spend outpacing prior quarters. It's driven predominantly by volume, right, rather than higher CPCs. And as we look at some of the long-term trends for CPC, right, Q1 is showing a bit of a spike, right? Paid search CPC is nearly a 3-year high in Q1. Shows a bit of a rebound from a Q4 lull. It's kind of indicates maybe a sharper uptick than typical seasonality. And higher bids are kind of showing that advertisers are aggressively pursuing the top placements again. So the competition's heating up. And maybe some budgetary tension as CPCs surge, even as maybe overall budgets kind of remain under scrutiny. It's maybe highlighting the trade-off between cost and visibility. So let's jump into paid social. Across the board, there was some stability. Q1 kind of saw a little softer impressions and clicks, and yet CPMs came up 5%. So demand remains fairly steady. I would reiterate for our listener that our advertiser base tends to focus on performance tactics through the social channel and potentially pockets of social publishers. And when we kind of started to unpack some of the data that underpin this, because sometimes we differ from general consensus, there were some very interesting pockets of insight. So we may in the future start to think about reporting on the social narrative relative to some of those vertical kind of clusters that we saw that with potentially enormous outsized share of growth that potentially aren't reflected in some of the broader trends. But as we look at some of the other headlines, right, Advantage Plus, a big uptake there. Adoption hit an all-time high. Even indicates kind of normalization a little bit after a volatile Q4. TikTok remained somewhat resilient despite potential ban concerns, and account share climbed to about 44% of our customer file. Though we saw some of their rapid growth rate dip a little bit, which tracks some of the trends that we might be seeing around shifts toward Meta and others as a hedge in the potential situation where a ban actually takes effect. And we saw some top performing verticals, right? Finance leading out ahead of the charge with 25% year-over-year spend growth. And even jobs and education also expanded even as costs were coming up. So Travel CPG retail budgets grew a little bit more cautiously, reflecting kind of more of a calibrated, but still an ongoing commitment to the channel. As we look at the social spending growth, right, all of social versus Meta itself, overall impressions were down 7% and clicks 8% year over year, again with CPMs up 5%. So kind of indicates steady demand, obviously at a higher price point, despite some of the softer engagement volume. Total spend fell 3% year on year as advertisers kind of balance cost pressures, potentially market headwinds with efficiency goals. Often we see the mid funnel as the in upper funnel is kind of the first area where marketers will pull back toward more performant lower funnel tactics. As we look at kind of the meta specific dynamics, though, big drop in impressions down 10% and clicks down 1% year on year, but CPMs definitely surged up 12%, making kind of strong competition for prime placements within Meta. And Meta's spend resilience despite the broader slowdown in social within our platform, right? Seeing spend edge up 1% really shows that maybe a few different angles, but advertisers' commitment to the very powerful platform targeting capabilities and potentially those potential hedge budget shifts from TikTok given a potential ban risk. Takeaway, right? I mean, we see social budgets kind of under pressure, especially for performance advertisers, but with CPMs coming up, across the channel, it's definitely showing strong demand for the high value inventory. And marketers are shifting maybe a little bit away from scale to efficiency. And as we look at the index against Q1 25 versus 24 on some of the core KPIs, right? Down 7% for impressions, clicks down 8%, right? CPM's up to $4.37, which is 5% year on year, with click-through rates roughly flat. Looking kind of, quarter on quarter, right? The post-holiday cool down, seeing a very slight drop in impressions, clicks down about 21%, as well as spend. CPM came down about 20%, as well as stands to reason given kind of the pressure in Q4. And looking at spending by month, January, February, definitely a softer start. Impressions kind of slipping 2% in January and 5% in February, but stabilized a little bit in March with only a 1% year-on-year decline, kind of indicating maybe a little bit of a recovery from Q4 volatility. And while spending hasn't fully rebounded, the leveling trend suggests a more consistent pacing into second quarter. Hand it to you, JD.
Yeah, sometimes charts don't really tell a real story, but when you look at this one here, follow me close on this one. This is really telling what's going on with TikTok. So let's start. The dark blue is spend, as you can see, kind of started to fall in the middle in the last year as marketers were a little worried about what would happen with TikTok, but share of accounts continues to climb. So the interest in TikTok is huge. It's just when, what might happen. And look, as you advertisers all know, it's not so easy. Some people think when they look on the outside, oh, I'm just going to take money, move it from one to the other. It's not that easy. There's agency contracts, there's platform contracts, there's new creative that has to be, built and approved and loaded, campaign execution. So marketers, I can understand if you're out there and you're thinking you're not sure what's going to happen with TikTok. So you're still going to use it. You still want to use it. We can see adoption clearly showing people are using it, but maybe you're pulling back just a little about what you've set aside for the year for TikTok until you see how things shake out. So great chart here and really telling the story of what's happened in the market. When it comes to Meta Advantage shopping campaigns, this AI format, Nick already kind of covered how this is growing much faster than social overall. But what you can see is that CPMs are starting to climb. Marketers, one of the best adages I've ever heard, and seems to always be true, is marketers vote with their wallet. So even if spend may not be following across all social, you can see spend going huge in Meta Advantage shopping campaigns as well as CPMs. And that really tells you what marketers are thinking about that. And then when it comes to adoption, we're seeing it spike here, the biggest it's been in ever in any quarter in our analysis, really just up to 35%. But here's the thing, that's across every client and account in our client share. I would imagine if I did a deeper analysis on our commerce only clients, that adoption would be much higher. And I'd like to do that analysis for next quarter. Social CPMs, we know social CPMs are really important all across the board in terms of where they went up and down, not really correlated to spend at all. Some spent more, some spent less, and CPMs were up and down. So very, very category specific when it comes to social, which makes a lot of sense. And then CPMs here, the actual CPMs. You can see vehicles still a really expensive category, but CPG, man, continues to be such a good category. Marketers at CPG, they're just super sharp, spending some of the biggest budgets in the world and maintaining that efficiency. Good to see. And long-term trend, regardless of what happened in the quarter, look at the long term. It's very obvious. You can take a look at this chart in 2 seconds and know what's going on here. Yeah, still momentum growing, still, up across the last 6 years. Social's here to stay. All right, as we wrap up, let's kind of talk about some of those key takeaways. First, of course, retail media and search big up. Search was up bigger than we'd seen in our whole period of analysis over a year. Social, as we talked about, kind of flat. CPCs really stayed good. Costs, even social CPMs in aggregate stayed pretty flat. That's really good. I mean, we think about Q1. Q1 is when we try out all our new cool strategies and tactics and all the different campaigns that we've been thinking about since we started planning for the new budgets back in the summer. So when you see Q1 come into execution and that the costs kind of stayed flat, that tells me marketers are really good at what they're doing. They know even when they jump into new emerging opportunities or raising spend in areas where they hadn't raised before, that they're maintaining that efficiency. And then the last big storyline were these formats: Amazon DSP, Performance Max, sponsored brands, and Advantage shopping campaigns, all up huge. Nick, what are you thinking here?
Yeah. In terms of the trends at a glance, absolutely. I think, when we look at the macro picture here, right, lots of optimism in the beginning of the quarter, some of the month-on-month trends pointing to potentially some trepidation about the pressures we'll see economically. It'll be a really telling report in second quarter to see if, indeed some of our hypotheses were right about, get hard into the game now while some of the economic signals have not quite hit the bottom line. Certainly, consumers are showing that there's a ton of demand to make purchases before potential inflation and costs, so that could underpin some of the click volume that we see. So it could be the massive pig in the python before the drop, or there's the contrarian perspective that there's strength in performance media, even through a downturn, and that not every product that is advertised in any given advertiser's portfolio of products is necessarily going to be hit with the same pressures, whether it's a tariff pressure or inflation pressure. So it's going to be even more important to have various product and SKU specific data if you are a product advertiser available to ensure you're advertising against true landed cost, true margin for specific products. So we'll definitely see a lot of focus on leveraging automation, tools for scale, aligning internal data sets with the marketing efforts to ensure that there's a profitable approach. It'll be very interesting to see what happens with TikTok and the potential ownership structure there. Obviously, we saw Meta kind of grade against the trend line of broader social, which indicates that there's potentially a safe haven there, irrespective of a ban or not. And I think across the board we'll continue to see again this focus for advertisers on finding value, but a willingness to compete, and we'll see clicks kind of track alongside potential inflation in the space.
I love what you're saying there. And, look, we're marketers. Market fluctuations happen all the time. There's seasonality, there's new competitors, there's new products launches. Sure, this might be, economic headwinds may be a little bit more of a market fluctuation than usual. But as Nick said, you just got to get smart. You got to get smart where you put your money, which formats you choose, how you measure things, being more holistic and not just focusing on the bottom, because you got to fill that funnel. So just stay smart, folks. And hopefully, when we look at the Q2 analysis next quarter, we'll see some really good stuff here. Once again, if you liked what we had here and you liked our data and you like what we're seeing, we've got plenty of stuff on the Sky Research Hub. We have our quarterly trends reports. Of course, I mentioned the state of retail media report, where we survey retail media marketers to see how they're feeling about the year. In fact, we've got a retailer version where we surveyed retailers from retail media networks to see how they're thinking. Really interesting stuff for retail media marketers to look how their peers across the aisle are doing. And then we have other surveys. We've got other reports, just some good stuff. So check out the Research Center for this QTR and other things.
Awesome. And that wraps up the Q1 QTR from Sky. I appreciate you making the time today. And as mentioned at the top of the call, you'll be able to download the report here, or you can wait for the email where this recording and the report will be delivered to you. So have a wonderful afternoon. Thanks, folks.